So without further ado, a few questions that come up. Number one, is this recorded? Of course it's recorded. We record everything that we do here at TheoTrade, literally everything we do here at TheoTrade. The recording, we'll even email you out a copy of such after the presentation. If you want my slides, they'll be available to you. A few things I like to get out of the way up front. Risk disclosure, we're not a financial advisor or a broker-dealer. The reason I throw that up there is, well, that's me, and I spent the previous 15 years of my career working in the brokerage side of the business. So let me give you guys a quick synopsis of who I am, what I do. Again, my name is Don Kaufman. I started trading in the late 90s, just about 3 weeks out of college, the ripe old age of 22. I went to Chicago. I had a cousin that actually traded on the floor, come from a family of traders. So, uncle traded, cousins traded, and I was interested in it. They offered me like a job to clerk. You put a 22-year-old kid, on a trading floor in Chicago, he's probably never going to leave. And one of the best pieces of advice, though, that I got when I first went down to the trading floor is they said, kid, and I was literally 22 years old, and they said, kid, learn everything you can, then get off the trading floor. It's gone. So I left the trading floor a short time thereafter, and I was invited into what at the time was called a startup. That was like not cliche as it is now. The term startup is extremely cliche now, but it was a startup firm. It was a startup brokerage firm, and that firm was called thinkorswim. And I was there very, very early on, from 2000, 2001, before the company ever really launched the thinkorswim trading application. So I went through a number of acquisitions, a few mergers. Eventually we went public. Was a shareholder through all that, which is a great experience. What I actually did for thinkorswim is I built and ran their entire education division. So if any of you guys have ever used the thinkorswim platform, and if you used it for more than a few years, I left thinkorswim and TD Ameritrade just about 2 years ago, almost 2 years ago to the day when I actually left the TD Ameritrade group. So again, I ran all of thinkorswim's education. I went on to actually run the education division for 7 million clients of TD Ameritrade. If you're not on the thinkorswim platform, that's all right too. I mean, listen, I know a lot of the different trading applications. Okay, the entire time that I worked for thinkorswim, TD Ameritrade, I traded, and heavily. And one of the things that I'm going to try to provide to you guys this evening is some of the experiences having worked at the brokerage firms. So, I threw this in here. I've done the CNBC appearances. People always ask me about that. You've been on CNBC? I don't look at this exactly as like the career highlight out there. What I do look at as more of a career highlight is going up against this individual. So he's not just one of the sharks. It's Mr. Wonderful himself. Anyway, he was long Apple. I was short Apple. And apparently I won that one because that's when Apple was trading near its recent all-time highs out there. Anyway, with that, I was right, he was wrong, but trading's not about being right or wrong. So let's get into it tonight, and enough about me. And by the way, if you guys have questions over here, any of us can answer, So with that, market manipulation. Manipulation, it's a very, very strong word when it comes to the markets. I actually don't love the term manipulation. None of us want to believe the markets are manipulated or controlled. In the 45 minutes that I have tonight, I'm going to educate you on these major points. How market manipulation occurs. What that really means, in fact. Okay? Why manipulation is now par for the course. I'll explain that statement and strategies, of course, you can use to take advantage of what we kind of term the new market manipulation. So there are a number of really key things. And I'm going to tell you right now, before we even dive deeply into this, some of the stuff tonight is going to be a little bit out there. It's going to be a little bit confusing, okay? Some of the stuff I'm going to bring to you, this is brand new, right on the bleeding edge of research that's going on in marketplaces today. Listen, strategies and so forth, it's all been done before. But what I'm going to show you tonight, okay, is when I say right on the bleeding edge, there are structural changes that have happened in the market that you may or may not be aware of that have actually caused manipulation to occur. And that's part of what I'm going to discuss. And then more importantly, take advantage of it, at least while it's going to last out there, right? Question is this: are you willing to put forth the effort? Now, as I said a moment ago, some of the stuff is going to be a little out there. The following course material can be extremely demanding to learn. All right? This course is not going to be, some chart pattern or following the bouncing ball with red and green flashing lights. And listen, I am a quantitative trader. It means I don't make a lot of decisions based on charts. I don't make a lot of decisions based on technical analysis. I have no problem with anybody doing that. But I want you to know right now, when I talk about market manipulation, okay, I'm not going to show you like, well, follow this chart and it's manipulated. It's ridiculous. Right? Markets are incredibly efficient, and we're actually going to use that efficiency to our advantage. If you really want to learn this business, you need to be willing to put forth some effort. And I say that because what I'm going to teach tonight, it ain't instant coffee and instant tea. This is a skill set all based on statistical data. Okay? What we are about to discuss involves market makers. It involves hedging activity. And again, recent changes in market structure. So everybody okay? Yeah? We're good? Yeah? All right. Let's move forward over here. Get in the know. You may not know where markets are going, but you can measure how far the markets can move within a given period of time. This normal fluctuation in the market, it's what we term expected move. Now, some of you that are joining us this evening, maybe you've heard of expected move. Some of you joining, you're like, I have no idea what that is. Okay? Well, what to expect with expected moves. Now, what we're talking about, for the most part, when I say like a normal fluctuation, we're going to look at a marketplace, right? And we're going to actually measure how far a stock can move within a given period of time, right? That is actually relatively normalized. So expected move does not tell us which way the markets are going to go, okay? But it does tell us the approximate movement. An equity means a stock. Apple's an equity or index product. Index product, okay, could be something like the SPX. That's the granddaddy of all the index products. So it can tell us approximate movement of an equity or index, all right, is likely to encounter within a defined period of time. Is that information helpful to you? So let's for a moment step back. By the way, these are not rhetorical questions. So like really when I say, is this information helpful to you, you chime in because again, I like to interact. For many years I did a lot of live presentations all over the world, and I like when people, yeah, no, okay. Well, here's one of the key things, though. You don't know, I'm telling you right now, expected move. It's not going to tell you which direction the markets are going to move, but it tells you approximately how far we are going to move, and it's critically important. So I'm going to go through an explanation over here, and this is where I say this is not instant coffee, instant tea. Not everybody is going to grasp every aspect of what we're going to discuss right now, but I'm going to do my best, and this is where, you have to kind of latch on and ask a couple of questions if you need to. Now, one of the things that I really want to mention here is what we're about to look at has nothing to do with past data. I hate that stuff. That's where like people get into charts sometimes. Somebody just mentioned like ATR, which is called the average true range. Well, that's looking at volatility, but that's actual price movement. That does me no good because actual price movement doesn't see what's coming. If you're driving home, do you want to drive home looking through the rear view mirror? I mean, think about that for a second. If you're driving home, I'm driving home looking through the rear view mirror. I mean, that's what using like yesterday's volatility is all about. Expected move is using about forward volatility. It's about looking through an actual windshield. So this is a stock, right? It doesn't matter what stock it is. You can call it any stock you want to call it, but let's start drawing on the screen. Oh yeah, I like drawing on the screen. I'm like the John Madden of trading over here. Let's say this is a stock, and the stock is trading right smack at $100. Okay, it could be any stock you want. I don't care if it's Apple. I don't care if it's the SPX. It could be the Spiders. It could be the IWM. It could be any product you want. All right, so it's a stock and it's trading right at 100. Now, the first thing you'll notice is this is what we call a standard distribution curve. Okay, now forget for a second that a stock even exists. Everything you do in your life, can be quantified in some way, shape, or form, okay, statistically speaking. And for instance, we were talking about driving a second ago, right? There could be really, really good drivers. Well, really good drivers would be up here in the curve, right? There's very, very few of them, but they're up there in the curve. Very, very good drivers. Then you have these kind of drivers, right? They're very, very bad. This is where you actually hope that Uber does figure out, self-driving vehicles, because they're so bad they don't even belong behind the wheel. But most of us fit in what we call the meat of the curve. And what's the meat of the curve? The meat of the curve, okay, is what we're going to call one standard deviation, which occurs approximately 68% of the time. Now, bear with me in this, because the 68% of the time just comes out of thin air. Well, most of us fit into the 68%. And that is, again, it's what we call one standard deviation. Now, if everybody in the world is a bad driver, okay, you still are able to quantify really, really bad drivers, and some of them are still going to be a little bit better, but we're all kind of bad. Still, 68% of us fit in there. Well, we're going to use, okay, some of the same statistical analysis for stocks. So here we have, again, this $100 stock, and we're actually going to call the stock stock. All right, that's actually what it's called. It's called stock. Anyway, we'll call the company stock. So it's this $100 stock, and you ask yourself, well, how far can this stock move within a given period of time? All right, so you have to look at expected. What's expected to move? Question mark. You tell me. Okay, how can you possibly figure out the answer to that equation? Now, I silence for a second, because the only thing you get in stock is what was yesterday's move? What was the move 3 days ago? What was the move 6 days ago? What people don't realize is that there is a marketplace to what's going to happen tomorrow. There is a marketplace to what's going to happen, all right? Let's have a question mark over here. Where is this stock going to be 1 month from now? Okay, that says 1 month. Where is this stock going to be 1 month from now? Now, I can't tell you if it's going to be higher or lower, but I can actually give you the marketplace, right, on what the expectations of movement happen to be, and that's what expected move is. How do you do that? Okay, we're going to look to options. Now, I said, oh, no, he said the O word. Now, listen to me very carefully. I don't care whether you trade stocks, whether you trade options, whether you trade futures, okay? You could trade chickens for all I care. Options put a price tag on risk to the future. That's what they actually define, is risk to the future. So when you take a look at a stock, okay, there's going to be options on it. There's going to be what they call a 100 call, all right? And there'll also be what they call a 100 put. You don't have to understand the definition for a call or put. A call, it's the right to buy the stock at 100. A put, it's the right to sell the stock at 100. Don't get caught up in the minutia of it. Let's say that the 100 call is equivalent to $3. Doesn't matter, hey, whether you buy it or sell it, let's just say it's a $3 option. And we're going to put the 100 put at a price of $3. Now, why is the call priced identically to the put? Because at this moment in time, the chances of the stock going up versus the chances of the stock going down are equivalent. But now you have to ask yourself the question, why is this option trading for $3? And why is this option trading for $3? Now, we know that there's an equivalency. Options are not, I mean, you turn on CNBC and they have you convinced, like, the option market will tell you which way the market is going to go. No, it doesn't. Because if it did, don't you think everybody would just jump on that and be like, yeah, the option market's going to tell us we're bullish? Come on, right? Markets are so efficient today, that's ridiculous. What's cool about this, though, why is this option trading for $3? I'll tell you why it's trading for $3, because some people, okay, are buying the option, some people are selling the option. The option price itself, it isn't what you think it is. It's not, like when I say the option price itself isn't what I think it is, like people are like, well, what price is options? The Black-Scholes model. Forget all that stuff. It's garbage now. It really is literally garbage. When I first got involved in this business, it was all about models and this. Forget about it. Really what prices options? Supply and demand. If everybody demands options on this stock, price would go up. If nobody really demands options in the stock, the price of the options is relatively cheap. Now, these options are good for a month. That's neither here nor there. The most important thing is that the call is trading for $3 and the put is trading for $3. And the reason the call and the put are trading for $3 each is that those options are putting a price tag on risks in the future. If you buy a 100 call, it gives you the right to buy the stock at 100. Okay? But if that option's trading for $3, you don't need the stock at 100. You're going to need the stock at 103 just to break even. Okay? Now, what expected move is based on are these option prices. And for the most part, when you add the call to the put, the actual price of the call to the put, you come out, all right, to $6. $6 happens to be what we term, we're going to call it an EM. That stands for expected move, right? That's expected move. Where did the $6 come from? Add the price of the calls to the price of the puts. Because some people are going to go out and they're going to buy a call, they're going to buy a put. Now, the marketplace in options is saying this stock could go not just $3 higher, $3 lower. If you add the call to the put, it's actually saying we could go up $6 or down $6. And that, ladies and gentlemen, would be equivalent to 68% of occurrences. Now, bear with me. We're going to go through this a lot of different times, and I'm going to show it to you in live markets. Because the first time people see this, they're like, what? Remember, add the call to the price of the put. Add the call to the price of the put equals, what, $6. Let me blank the screen really quick. Let's go back to it. We have a stock. Stock is trading at 100, all right? This stock is trading at 100. That call, that 100 call, is trading for $3. This 100 put is also trading for $3. Add them up. They equal plus or minus what we call 6. Why plus or minus? Because you don't know if the stock's going higher or lower. So what we get is this range of plus $6 or the range of minus $6 from where the stock currently is. That range, okay, is what we term expected move. And you'll stay in that range approximately 68% of the time. That's what options are based on. Okay? But here's the best part of it. The options, they're not what you think they are. They're a price tag on risk in the future. You see, everybody in the business, they like to go out and they like to, let's look at a chart here and let's determine if we're going to go higher or if we're going to go lower. Forget that garbage. All you got to do is go to any stock you want. We're going to pick some stocks here in a minute, but you go to any stock you want and you start to look through individual stocks and you ask yourself, like, let's go to Microsoft. Why did I pick Microsoft? Because it's trading like right at $60. You can tell where Microsoft is priced to go. Okay, bear with me here. This is a 60 call and a 60 put. And you may have never in your life looked at an option chain. That is A-OK. Here are the 60 calls. Here are the 60 puts. Notice anything interesting? Look, these are trading for about 44 cents. These are trading for about the same. You know why the call is trading the same as the put? Because we're trading almost at $60 on the button. So it's actually pricing the what? Just like we planned out. And what does it equal? If you add basically 45 cents to 40 cents, what does it come out to? 40 cents plus 45 cents comes out to about 85 cents. Okay, plus or minus 85 cents. So the expected move for Microsoft in the next 3 days, it could go up 85 cents, okay, or down, 85 cents. I rounded over here. But it's going to go up 85 cents or down 85 cents. From where? From $60. That's its expected move in the next 3 days. That information help. Okay? Now, again, forget about anything that you may have heard about open interest or volume or anything. It does not matter. Okay? That's all garbage these days. We're a much more efficient market. Most of the information that retail clients get, it's so old. Okay, expected move and probability. Expected move defines a one standard deviation. As we said, 68.3% of occurrences. Therefore, there's a 68% probability of an underlying closing inside of the expected move by a designated expiration. Okay, that's all it's saying. Continue on. Not every trading application that you have, okay, would have expected move. The only thing you need, if you ever want to figure out expected move, and again, I want each and every one of you to be able to leave this chat room tonight and have something tangible to look at and to use tomorrow. Now, I don't know if you trade all day, every day. That's fine. That's up to you. You got to realize you could use this each and every single day in your trading. You could use this if you're an investor. An investor goes out, I buy a stock, hold it for a year. What does this mean to me? Well, if you went out and bought the stock and held it for a year, and that stock happened to be Tesla, and the expected move was $50, don't you think you should know that for a year? Okay? It's crazy amount of risk. Not every trading application has expected move, but, okay, any trading application that has options use the at the money straddle as an alternative for expected move. Let me show you. Okay, this is straddle price and expected move. This is Facebook. Now, this is an example for you. The expected move and this trading application that we're on here happens to be thinkorswim. All right, but you don't have to have thinkorswim. I don't care whether you have Interactive Brokers, whether you have, Charles Schwab, if they have an option chain. Even if you've never traded an option in your life, okay, I'm begging you, you better be looking at this. All right, if you're not, you're doing yourself a huge disservice because what we're going to be talking about. And listen, I'm going to back everything I do up tonight with some serious data points. Like, again, I'm a quantitative person. I'm not going to go in here and just be like, this is expected move, go along, move along, just use it. I'm going to show you the expected move, then I'm going to show you if it works. That's what you want to see, right? And then, moreover, we're actually going to teach you strategy around it, okay? And we're going to explain why and what that word manipulation means. Because, again, it's a bold statement. Markets are manipulated. It's a very, very bold statement. Well, let's back it up. So here on Facebook, you see the expected move. On thinkorswim, you can find the expected move right on the right-hand side of your screen. I'll show you that in a moment. You can use expected move of the at-the-money straddle. Continuing on. Expected move examples. Let's look at a few stocks and determine expected moves. Now, you call it. Come on, type them in. Type them in. What products would you like to evaluate? Give me some stocks. All right? The SPX. Google Priceline. By the way, Priceline's pretty evil. I do warn you of that. The XBI, I like it. CMG, it was an 800-pound burrito, now turned to 400-pound burrito. Sweet, I got a ton of them. Let's do it. I'm going to go right on to the trading application. All right, so we looked a little bit at Microsoft there for a second. One of the first ones that came up, okay, like Apple. Oh, please. All right, I'll do Apple. How far out in time? Let's do Apple. Okay, and we're going to go a little bit out in time, just 10 days. Just 10 days. Why? Because I want to have fun with it. Apple is trading like almost right at 110. It couldn't be a better example. The expected move, where's it found? Where's it found? Where's it found? On the right-hand side of your screen, the expected move is right there. If you're on thinkorswim, that's where the expected move is. Now, the expected move calculation says plus or minus $2 and basically 50 cents. Okay? Plus or minus $2.50. That's the expected move. Now, what I want to elaborate upon here, so plus or minus $2.50. That doesn't say we're going up 250 or down 250. It says we're going to move up or down 250. There's no directional bias to that whatsoever. Now, bear with me here. If you don't have thinkorswim, take the 110 call plus the 110 put, comes out to 225. Now, deep breaths, 225 differs from 250. Okay, there is a very mild difference. Adding the call to the put is the dirty methodology of it, but it doesn't matter. As long as you're consistent, it'll be perfect. Okay, just seriously, this is a $110 product, and people are worried about there's a 25-cent difference, Don. Okay, deep breaths. They make medication for this, but In all seriousness, 25 cents is negligible given the fact this is a $110 product, right? 25 cents is, again, a fraction of a percent off on a $110 product. So I wanted you to see the expected move for Apple. Then somebody mentioned Amazon. So let's go take a quick glance at Amazon. Close this up. Amazon over the next 10 days? No! Let's look at Amazon between now and the end of the year. 24 days out. Dun, 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 dun. It's about 35 and change. Let's call it 36 bucks. Or the product's trading almost at what? 765. Add the 765 calls to the 765 puts. That's $33. Remember, $33 to $35. It's not a massive. It's like a $2 difference. But again, this is a $765 stock. Okay? Now, this is incredibly important. By the way, Catherine was asking about, you don't have to use the theoretical value of options. Theoretical value of options is all garbage. You don't ever need a theoretical value of an option. For the most part, liquid markets, the theoretical value is the mid price, okay, of the option. So I wanted to elaborate upon a couple of different stocks. Now, one of the ones that we're going to be looking at a lot tonight is called the SPX. It's called the SPX, and there's 1-day options and 3-day options and 6-day options. The SPX is highly unique. Now, some of you may have never, ever, okay, looked at this before. But the SPX, there's 1-day and 3-day and 6-day and 8-day and 9-day and 13-day and 15-day and 17-day and 21-day and 22-day. Each one of these is a unique expiration. It's insane how many expirations there are. Bear with me. This is where stuff's about to get interesting. You guys ready? Deep breaths. Down and dirty on volatility. Traders and investors alike. They spend tens of thousands of hours, not to mention tens of thousands of dollars, consulting charts, trying to figure out the next move. Were you aware that option pricing and volatility give you a real, what we term, skin in the game marketplace on what the world perceives risk and movement to be? Think about that, because that's when I'm showing you the expected move. This stuff isn't pulled out of thin air. Here's an option that expires when? December 7th, Pearl Harbor Day. That expires tomorrow. It's Wednesday. It's tomorrow. The option is already dictating that the market's supposed to move $8.31. $8.31. Okay? Does this stuff really work? Does it work? I mean, as I told you, don't take anybody's word for anything. People look at charts like, oh, well, this worked in the past, and they pat you on the head. It worked in the past. I back tested it. Forget that back testing garbage. It ain't gonna work, right? You want to look at real moves. This is a real move. Let's take a look at a few recent examples in the SPX options, because this, you can't fudge data. First, would we all agree the recent presidential election trading week was rather insane with volatility? I mean, I think that's a pretty fair statement. Presidential trading week, the Sunday before the presidential election, that Sunday, the FBI data came out. Then on the Monday, we had the FBI rally. On Tuesday, we didn't know what to do. All right. Tuesday night, the futures went limit down. The market exploded higher on Wednesday. It was totally insane. Let's look at what the expected move on the SPX was days prior to the election, then see if markets moved as expected. Right? I mean, that's the only fair way to test it. This is the SPX, the week of November 6th. Now, if you're not having the calendar, November 6th, what was that day? So look back at the calendar. November 6th was actually the Sunday. This is the day that the FBI came out with data. Okay. Now, the cool thing about this was the marketplace knew nothing about what was going to happen on the weekend. But this screenshot, I cannot elaborate upon this enough. This screenshot is actually taken specifically on a Sunday. And it's from the closing prices of Friday. So the market was at, look, 2085. The expected move for the entire week. What I'm looking at is what was priced to happen between now and November 11th. That's 5 days till expiration. The expected move was $71. Guys with me? So this is before the election. Nobody knew anything. All right? Nobody knew if it was going to be an upset. Here you go. Here's the data. SPX price on November 11th. In one of the most volatile weeks in recent history, the U.S. presidential election, the SPX option markets pegged the movement in near perfect fashion. Perfect fashion. The expected move priced a 71-point swing. The actual move was $79. Oh, you're like, oh, it was 8 points off. It was 8 points on a $2,164 product. Not bad, considering it's one of the most and largest unexpected events in recent history. Look at this. We traded from 2085 to 2164. How the heck is that even possible? How is that possible that the SPX got it? Well, that's exactly what I'm going to talk to you about. But let's have some more fun. This is the SPX, okay, the week of November 27th. November 27th, you're like, what? That was last week. It was last week. Here's the SPX. 2213. This is, again, there's the actual date. It's 11/27. What was it? Again, to be clear, on the 27th of November, so everybody's aware, the 27th of November, that screenshot is taken on a Sunday. Now, the reason I take a screenshot on a Sunday, right there, is ultimately because it comes off the closing prices of Friday. The market has no idea what it's going to do on Monday. False. It does have an idea what it's going to move on Monday. It's already pricing in a $10.30 move with 1 day to go to expiration. There are Monday options now that expire. So what actually happened? This is on the 27th. So what happened by the close of the 28th? You ready? You ready? We moved $11.63. The expected move was $10.29. The actual move was $11.63. You missed it by basically, what, a point? But it's a $2,200 product, but you missed by 1 point. We can go all night. I can show you the expected moves have projected the closing prices for the SPX all night. These expected moves are what we now term statistically significant. Okay, statistically significant. It means we've done our homework and these expected moves are happening consistently. How does this work? And more importantly, how can we translate expected moves into us making money? And this is the most important thing. How does it work? Number one, why does it work? Because if you're not asking that question, this crap ain't magic. This is not, and I'm going to pick on you guys for a second. This is not some like Fibonacci. You're like, oh yeah, I got Fibonacci ratios and I'm pulling it out of thin air. You're killing me. I grew up around quantitative traders. The idea of an all-knowing, all-seeing concentrics of life are telling me where the market's going to go. It's ridiculous. Okay? I'm going to tell you why this actually works momentarily. The most important product in the markets. The SPX is the single most important product in today's marketplace. Plain and simple. The SPX is the single most important product in today's marketplace. You may have never heard of the SPX before, but it's the single most important product in today's marketplace, right? I'm going to explain why here momentarily. The SPX is a $2,200 options-only product. There is no stock. It is not an ETF, right? No stock, not an ETF. Okay. By the way, somebody was like, what about that Elliott wave? Oh, yeah. Oh, come on. You're killing me. All right? It's an all-knowing, all-seeing. It's in a type 4. Why is the SPX the single most important product? Okay? Allow me to present some invaluable data to you. This is what has changed in the market. First of all, why do SPX options have so much importance? Okay. Let's come down to the statistics of it. In 2016, the average daily options volume has been 16.2 million contracts per day on all products. Please bear with me. This is very important data that I'm going to present over here. Because again, as I said, if you ain't got statistics to back it up, I'm not listening. And I don't want to see charts from the past and predicting the future out there. I am going to show you why this is the most important product and why the SPX is actually moving the markets. So in 2016, that's this year, options, all options, totaled about 16.2 million contracts per day. This screenshot data provided by the Options Clearing Corp. It's the OCC, the Options Clearing Corp. Okay, provides this data on a day-to-day basis. This was that particular day. I took the screenshot right here, November 21st. But what I wanted you to see is right there. That's the average total volume. That's the entire options marketplace. Stocks, options, that's it. You know, all the options traded on every single stock, it trades about 16.2 million. By the way, November 15th, it traded a little bit more. So the volume has been flat. But there's been a major change over here. Get ready for it. Get ready for it. Okay. November 21st, 2016, the SPX volume was 1.25 million contracts. This is Chicago Board Options Market Summary for November 21st. I just picked, by the way, I picked an arbitrary day. I picked November 21st because I was putting the slideshow originally together back then on some data points. And I broke down some of the volume in here. But again, it's important to know that the SPX that particular day did about 1.2 million contracts, right? Bear with me. Here we go. So there's 16.2 million option contracts traded per day in 2016. But the SPX options in 2016 are averaging approximately 1 million of those contracts. So let's just do some quick and dirty, what I call napkin math, right? So if the SPX is trading 1 million contracts, but we're doing 16 million contracts a day, the SPX is worth 1/16 of all volume during the day. Guys with me? The only problem is the SPX is a $2,200 product. So the SPX contracts are roughly worth 20 to 30 times the size of the options contracts traded. What that basically means is look at Apple. What is Apple? Apple is trading at 110. The SPX is trading for what? 2,200. So what can you say? Well, the SPX is roughly 20 to 30 times the average size. In fact, the real number, it's even more than that because there's a million different products that are trading for like $50 out there. Anyway, the SPX is 20 to 30 times, okay? In addition to it, the SPY. What's the SPY? The SPY, it tracks the SPX. It also accounts for an additional 3 million contracts plus per day. So wait. Let's do some what I call do the math. Do the math. Okay, let's do some math. There's 1 million SPX contracts trading per day plus 3 million spider contracts per day equals 4 million total contracts. Now, the quick and dirty math over here, let's not add anything up just too crazy yet, so 4 million contracts. Now, this is 4 million contracts of a total of 16 million that are trading per day, which equals basically 1/4, or what we call 25%. So 25% of all the volume that happens in options is around the SPX and the spiders, two products. Of the 16 million contracts traded per day, 25% of the daily options volume on any given day is directly related to the SPX and the expected moves. However, in terms of notional value, that's a big term. Notional means the SPX is the granddaddy of all the products, right? It's 20 to 30 times the size of the standard option contracts. In terms of notional value, the SPX options make it well beyond 60% of the total value traded per day. So the real answer is 25% of the volume isn't, okay? Yes, on a volume basis, 25% is, okay? But on a notional value, meaning how many dollars are traded, 60% of all option contracts are around the SPX. It's ridiculous. This is why, okay, things matter. Now, I'm going to get even crazier on you. What's going on? What changed in the markets? This is actually, you guys are welcome to look these up, okay? Chicago 1st, 2016. This is the PR Newswire. The Chicago Board Options Exchange today announced it plans to list the SPX Wednesday expiration. Now, there's been weekly options for a very, very long time. And weekly options are very near and dear to my heart. Why? Because I worked for thinkorswim. And very few people know this. But who do you think was the creator of the weekly option? Well, I worked, okay, with and for two individuals that created the original weekly option. We as a firm sold the idea to the Chicago Board Options Exchange. I was there. I'm the one who helped give the presentation. Okay? Except the first time it was not called a weekly. This is no joke. This is serious. We originally called the product the Quickie. And we're like, oh, who wouldn't want a Quickie? You can't even make that up. I mean, and the people at the Chicago Board Options Exchange did not find that nearly as amusing as did we. But they listened and they wrote us a check. We literally called it the Quickie. And the punchline was like, oh, who wouldn't want to trade a Quickie? Who wouldn't want a Quickie? They didn't find it nearly as funny as we did. So in February of this year, and again, I told you there were structural changes that happened. That's February of 2016. But wait, there's more. So then they had a Wednesday expiration added. On top of what already existed was every single Friday there was an expiration. So all of a sudden you had a Wednesday expiration and a Friday expiration. So they said, what the hell? July 11th this year, starting on August 15th. August 15th? That just passed a few months ago. They added a Monday. So now there was a Monday, a Wednesday, and a Friday expiration. Again, this is the PR wire right here. It announced today the Monday weeklies. Pretty sweet, right? So they're planned, again, for the first expirations. Initial expirations didn't start to the end of August. These things have only traded, what? September, October, and November. There's only been 3 months of this trading. Okay? They're there. Check them. Now, here's the crazy part. Behold, the SPX have completely changed the game. Years from now, traders are going to be discussing how the addition of multi-week Monday, Wednesday, in addition to Friday, okay, options in 2016 changed the game. No one's talking about how the efficiency of the markets is far beyond that of ever recorded in the history of this business. Our research attributes the level of efficiency. Now, when I'm talking about the level of efficiency, I'm talking about this. There's a reason that the markets, they say that we're going $10. Okay, bear with me when I come back over here to the SPX. I close this up. There's a 1-day expiration, a 3-day expiration, a 6-day expiration. Because you have all these expirations, the expirations themselves, people, they're giving you data points that people aren't even looking at yet. When I say data points, these are marketplaces that are telling you, listen, they're telling you, okay, we're going to probably move about $8 here. Let me fix that really quick. You know, the data points are saying we're going to move $8 here, we're going to move $15 by this date, we're going to move $17 by this date. But it's not just like, some arbitrary number. This ain't no Fibonacci, all right? This is a real market. People are trading tens of thousands of contracts in these things. There's billions at risk. And the billions at risk say we're going to move $17. And we're going to move $17. That's the whole key over there. So our research attributes the level of efficiency to the onset of multiple weekly expiration, the Monday, Wednesday, and Friday options. As market makers, hedge funds, and risk managers, they're hedging their collective risk using these options. And the market are directly doing what is quote-unquote expected. All right? It's very serious stuff that very few people are on. I actually originally thought to myself, I'm going to write a white paper on this, okay, which I still might do. A white paper basically is an industry-wide paper and, get a little recognition from institutions and so forth. And then I thought to myself, screw it, I'm just going to do a class. And that's what we're looking at over here, the summation of the SPX options. The SPX options are now expiring 3 times per week. The additional option expirations, Monday, Wednesday, and Friday, have changed market behavior via creating relatively measurable market moves via looking at the expected moves. TheoTrade has developed a low-risk strategy to envelop these expected moves. And that's the key to it. So you got to understand, okay, number one, behold, it's changed the game. Number two over here, the Monday, Wednesday, and Friday, it leaves nothing to chance anymore. The markets are pegging expected moves. Now you need a strategy to trade it. Positioning yourself around expected moves. Let's get down and dirty. How do you position yourself most effectively around these SPX expected moves without absorbing large amounts of risk? And don't get cute, because there's millions up for grabs. Butterfly spreads. butterfly spreads is an age-old strategy. We will use the standard low-risk butterfly spread in order to take advantage of SPX expected moves. The idea is easy. We want to achieve maximum reward for a very minimal upfront cost. The butterfly spreads around expected moves scream, limit your exposure and maximize your potential. It's what I call a butterfly's guide to expected moves. Now, tonight's presentation, it displayed the setup for the butterfly. You may or may not know, okay, that a butterfly, again, it's an age-old option strategy that takes, again, very minimal risk and creates potentially massive returns. The butterfly, though, in conjunction with the correct understanding of the SPX expected move, can be an incredibly powerful combination. This is a risk graph of the butterfly. And in this particular risk graph, and again, the risk graphs are very liberal, I think. Okay, this is a trade where you can basically risk $55, not $500. You can risk $55. You can make almost as much as $1,000. You're not going to make $1,000 on it. You're going to risk $55 and probably make about half that, $500. But you got to be right. And being right and hitting this is a matter of understanding expected moves. Okay? And I don't mind telling you, because reasonable butterflies, I can find them all day long between $50 and $100 all day long. It's very, very minimal risk. And if you don't like using the SPX, you could do this in the spiders as well. Here's a few characteristics of butterflies around expected moves. First of all, this is the trade that I just showed you. That's the risk graph for this trade. Okay? The butterfly has historically been a lower probability trade. However, the knowledge of expected move provides, okay, the savvy retail trader some edge. We're all retail traders. I'm a retail trader. You're a retail trader. That's what we're trying to do, is get some edge. Really, one of the main characteristics, there's significant profit potential, but minimal risks. Because sometimes unexpected move, guess what? You're going to be wrong. Okay? You're going to be wrong. Trade can be placed multiple times a week. Now, the direction, you're thinking, I got to know the direction. Not necessarily. Not if you risk an extremely minute amount. Trade need not be closely monitored. And exit orders can be placed as GTC. GTC stands for good till canceled. The trade, again, loses minimal capital if the markets make massive moves. That's important. This is also an excellent tool for those seeking really large returns, okay, on potentially smaller accounts. It could be a large account, a small account, doesn't matter. All you have to do is basically litter a couple of butterflies out there. And I'm not asking you to place a ton of trades, because a ton of trades is going to be commission intensive. Got to be commission conscientious. Building the butterflies around expected moves. Do not let options intimidate you. The spread below is being done for a 55-cent debit. That means one contract, okay? One contract equals $55 plus commission, all right? And hey, I don't mind throwing, hey, there's a little bit of commission in there. But you have to realize this entire spread, it's kind of what I call like a massive chainsaw. Used correctly, could be really effective in creating, returns. Used incorrectly, probably going to cut off a few fingers. You need to know how to use butterfly, and how to use that butterfly, and more importantly, how to build these around expected moves. People are already chatting in over here. They're like, how many good trades do I have to have? Okay, do I get bullish? Do I get bearish? These are the right questions to ask. Fear not the butterfly spread. Again, you may or may not know options, or you have limited experience in placing option trades. We can show you how and when to place butterflies around expected moves in a matter of a few hours. TheoTrade, what we actually do as a firm, we create detailed recipes for every trading strategy, including the butterfly surrounding the expected move. And I like to give good analogies. Earlier I was talking about the car and looking through the rear view mirror to drive home. But one of the best analogies I can think of for trading is, baking a cake. You would not, you just wouldn't go out and bake a cake without a recipe. I mean, if you've baked a cake like 50 times, I'm sure you could do it without the recipe. But even then, you probably glance over, you're like, it's a half a stick of what? So we actually build recipes in order to be able to trade. I mean, that's what we do. TheoTrade builds recipes. I mean, it's criteria. It's what we at TheoTrade do. Trading, and here's all the questions that are coming in here. Trading is all about answering the what ifs. What might be a good stock or ETF candidate for a butterfly around expected moves? Can you do this in the SPX? Well, of course. Can you do it in the spider? Yeah, I just gave you two good candidates. That actually answered that question. What's the correct options expiration cycle to buy my butterfly? Ooh, yeah, there's a Monday, there's a Wednesday, there's a Friday. Well, based on my data, okay, I'm going to actually key into what options expiration. You go too far out in time, you're dead. You go too shallow of time, you're dead. How much capital do you need to commit to the butterfly spreads? What strike price options do I sell? What strike price options do I buy? A butterfly is a buy, a sell, a buy. There's actually three legs to it. TheoTrade answers those questions. We'll give you the right probability for my trade because butterflies are based on probabilities. How many option contracts do you trade for your account size? When do you close the butterfly? Okay, what if the markets move MIG? What's the correct, return for the strategy? When do you get out? What if the stock moves massively, right? Can you fix a losing trade? People love that, right? We've got answers. We've got answer to all the trade-related questions. That's what we do. Again, we build recipes with definitive criteria, checklists. I mean, if you're going to be a pilot, you go through you sit down in the cockpit, and the first thing you do is whip out the checklist for each strategy and each unique variable you're going to encounter. The pilot gets up, they walk around the airplane. That's just answering the how, when, why, at what price. It's just the beginning of all the different variables you face while buying butterflies surrounding expected moves. And again, the secret's kind of in the sauce. Now, again, a lot of people think, I can read about these spreads anywhere. You can actually go Google right now what a butterfly is. Seriously, go Google what a butterfly is. You're probably going to find, 5,000 sites. Okay? What you will not find, though, is anything but the strategy. You'll find the strategy. This is a butterfly. The strategy doesn't actually make money. It's all about corresponding criteria. And we spend months fine-tuning the trade setup and the criteria. So I've been watching the weeklies since inception of weeklies, okay? Since they started doing the Friday weeklies. Then I started watching very, very carefully after they added the Wednesday weeklies. After the Monday weeklies, I knew there was something huge going on over here. So we have spent months fine-tuning the setup and the trade criteria. And really, if you want, we have the criteria to building a butterfly surrounding the SPX moves. And we're going to do a class on it. And I already mentioned that we're going to do a class on it, in a few hours. It's called the Butterfly's Guide to Weekly Returns. The class, it's this Saturday, December 10th. It's from 9 a.m. to 12 p.m. Central Time. I'm actually going to be the instructor for this. Now, I mentioned I'm going to be the instructor because TheoTrade, this is not a firm that's about one individual. Okay? Yeah, I'm one of the co-founders of TheoTrade, but you know what? We also brought on Doc Severson. Doc's been around options a very long time. We also brought on a gentleman by the name of Jeffrey Bierman. Jeffrey Bierman worked with me at thinkorswim for 7 years. I don't look at charts, but Jeff Bierman does. So does Doc Severson. We also brought on an individual by the name of Tony Rago. We also brought on an individual, by the way, Tony's our futures guy. We also brought on, none other than Slim Miller, Steve Miller. Lots of people like Steve. You know what he is? He's into cyclical analysis. Just because I pick on technicals and charts and I'm not into Fibonacci's, well, I surrounded myself by a bunch of market technicians. All the classes are archived immediately and available indefinitely. Okay? The class is only $197. TheoTrade.com/fly. I'm going to go through a little bit of the class over here, and I'm going to answer a few questions over here, but I'm not done. The class, has multiple additional classes with it. What are the additional classes? Bonus number 1, it's Options 101, the basics and beyond. These classes, are included in the $197 price. We do this because we want everybody on a level playing field. Okay? It also includes an additional class. By the way, the Options 101, it's not a short series. This is a 5-part series. Each part, how long is it? About 45 minutes. There's Options 201. This is a 5-part series. Okay? Then there's Options 301, Volatility and Expected Move Essentials. This is a multiple part series. This one's about 3 hours total. You will be amazed by what you'll learn in 101, 201. I don't care how much experience you have in this business. You could be a market maker on the floor. You should still check out 101, 201, and 301 because we look at options from more of a probability and price perspective. All of these classes are included in addition to, okay, the Saturday class. And the Saturday class, it's scheduled for 3 hours. It's probably going to go a little bit over. If it goes a little bit over, okay, it's all right. We'll answer some questions over there. We'll laugh or cry. The whole thing's $197. It's TheoTrade.com/fly. Here's exactly what we're going to do. This is the curriculum. You're going to learn how to use butterfly spreads to take minimal risk and produce really astonishing returns. Discover the market structural changes. I've already discussed that a little bit, but I'm going to go deeper. Understand how markets do provide predictable or manipulated ranges. Okay? Build your own butterfly spread. Now, I'm actually going to talk about the butterfly spread itself with detailed step-by-step entry and exit criteria. Read market risk, okay, like nothing you've ever seen before. You're going to get a lot of insights. And I bet you I provided a couple of insights tonight. And this stuff isn't available anywhere, okay? How you can trade this butterfly several times a week you do not have to continually monitor the positions. It's kind of what we call set and forget, good till canceled orders. Discover how to create trades based on expected moves and not purely direction of the market. And these trades can be done in a retirement account, very minimal options experience. You can have a smaller account. You know, I think you have to have about $2,000 in the account to be able to trade spreads in that account. All right? And I'll go through each and every one of the bullet points if you want. If you have questions to class, again, we've got people answering. Now, you can go to just the class. Fantastic. Again, it includes all 3 additional classes, so it's a total of 4 classes. Or would you like to access every class we have ever done before and access to every class we will do for the next year? Okay. We also offer, okay, under TheoTrade.com/fly, we offer what we call Total Theo. And what Total Theo is, it just gives you access to everything that TheoTrade does. And allow me to explain this because you're like, it's $997. Most education companies will charge you $997 for one class. It's a class and it's got a couple of days of live trading. How about you join us 250 days a year for live trading if you want, if you got the time to do it. If you don't, I get it. How about we have futures trading? We have stock trading. We have options trading. We have technical analysis. Okay? We have all of the technical indicators you could ever want. We give them to you for free. Okay? That's part of TheoTrade. Anyway, it also includes all of these classes. Essential skills for consistency in trading. The next big short. That's the wrist twist class. Okay? Did that one in September. Guide to selling high probability spreads, surviving extreme volatility. Each one of these is a unique class with unique criteria. Sell premium and manage risk. Right there, okay? I'm going to tell you, that class alone is worth $1,000. Easy. Covered calls, income generation for stocks, weekly options class, a fractal energy class. This is a technical analysis class. Increasing vertical spread probabilities with technical analysis. That's a Doc Severson class. This is a Doc Severson class. Small account, Doc Severson class. Top 10 skills for growing small accounts, another Doc Severson class. The weekly diagonal. Okay, what's that? It's a Doc class. RSI Unleashed. You guys will love that. That's actually an indicator, okay, that we built. Essential skills for consistency in trading class. Again, and a minimum from this point on, a minimum of 1 class per month. And we do classes on futures. We do classes in everything. This is what it looks like. Now, again, the address over here, it's TheoTrade.com/fly. Let me for a moment show you. Again, we have gone through the Butterfly Guide to Weekly Returns class. If you go to that class, again, all the bonuses are part of it. Bonus classes, 101, 201, and 301. And the reason we do those classes, again, it's to get everybody on a level playing field. Now, today is already Tuesday. Okay, it's Tuesday night. You can sign up for the class. You can start watching this material tonight. I know it's late, especially on the East Coast. It's kind of late. You can watch it tomorrow. You do not have to necessarily get through all these classes to understand the butterfly class, okay? But I'm telling you, check it out tonight. It's worthwhile, right? I think you guys will love some of the material. And again, everything we do is archived. Everything we do is archived out there. That means from the 101 to the 201 to every single trading day that we do. Now, that is the Butterfly's Guide to Weekly Returns class. That's the $197. Now, where a lot of people have questions is what we call Total Theo. Now, what does Total Theo include? Here's all the classes, okay, that we've done already. Each and every one of these classes, here, I'll show you. Each and every one of the classes, okay, they're available. This is our site. It's me! And this is our chat room. People can chat in. And when you go to the class, when you go to the butterfly class, you're just going to hop in this chat room. Like, we don't differentiate. We don't have any special, like, we don't use GoToWebinar. GoToWebinar, it's age-old technology. We actually built just like a TV channel, and you can watch this. You can zoom in, zoom out, ask questions down here. You can pop the chat out. But in addition, with Total Theo, you'll have access to the archive. And what the archive looks like, well, we're going into the archive right now. Here's all the classes that you can have access to tonight. You just go in here, pick any class you want. Okay? I know. It's totally and completely overwhelming. It just is. There's a lot of stuff to look through. But like, for example, if you want to know everything about fractal energy trading, just click on it. After you click on it, you can download the slide decks. Okay? You click play, it will start playing. All right? And we break each one of the detailed classes into multiple hour-long bite-sized chunks. Again, there's download the white paper, download, the slide deck over there, but I wanted you guys to see what this looks like. Now, in addition to that, for those of you interested in what we call Total Theo, what does $997 include? It includes every single class we do, but we also have a live trading chat room every single day. Not everybody can attend that. Like, I get it. Like, you're like, Don, I actually work during the day. That's fine. You don't have to be in the chat room, but we do it. You do realize that some firms, they have chat room. They'll charge you $200 a month just to go to their chat room. Then they'll charge you $1,000 per class. Good luck. You're going to spend a fortune. And they have 1 or 2 traders. Okay? Again, which traders? We have myself, Don Kaufman. We have Doc Severson. We have Tony Rago, who's a futures expert. We have Jeff Bierman, okay, I will put money, any amount of money. He knows more about the thinkorswim charts specifically than any other individual alive, because Jeff, for 7 years, worked to build the thinkorswim charting application. So when you look at all the features on thinkorswim, you're like, my gosh, there's a lot of stuff on here. Yeah, that was Jeff. A huge amount of it. Okay, we also have Slim Miller. All right, Steve Miller, yeah, he worked in some very large firms. Steve's now in his 60s. He has over 44 years of trading experience behind him. He's also in the chat room on a day-to-day basis, but it's all archived. Okay, you miss anything we said, find it in the archives. Okay, so that's the live trading room. We do provide trade ideas all day, every day. But what happens if you can't sit in the chat room all day? Well, that's okay too, because we email out trade ideas. Read trade, like if you need real examples, we email trades out to you. You could just copy the trades. You could trade any brokerage firm you want. We don't care. You could be anywhere in the world. Somebody's from Australia. They can't access thinkorswim in Australia. That's fine. Just copy the trade, put it with any brokerage firms. If you need scans or studies. Now, again, lots of firms will charge you for different scans, different studies out there. Let me show you something really neat. On TheoTrade, first of all, we have a trade tracker. What's a trade tracker? You can look through every trade that we have done. It's just a spreadsheet. It's really not very impressive from a technology standpoint. But we also actually have all the shared charts, scans, studies. These are all, okay? People are like, we have a proprietary study. Listen to me. There ain't no sacred cow. There is no sacred cow out there. We will give you whatever you want. If I've got it, I'm going to give it to you. I don't believe that somebody has a proprietary, it's a secret squirrel study. Forget that. We'll give you every scan, okay, every study that you can possibly think of. We just scour the markets looking for this kind of stuff. I mean, it's part, again, of Total Theo. That's what we do. Now, again, the web address is theotrade.com/fly. There's a couple of people asking about that in there. Now, have we done enough over here? You need scans or studies. They're all included. Real trade examples, archives. And when I say archives, each day, we don't just talk at you and be like, yada, 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 yada. This is what the market's doing, yada, yada, yada. Each day, we do what's called a coaching session. Here's the coaching archive. What's a coaching session? Every single day, we pick a specific topic. All right? Let's pick a day, pick a month. Oh, let's go back to February. I like February because I'm an options geek, and I went options geekisms in February. But if you want to know Vega, calendar spreads and volatility bombs, beta weighting, theoretical pricing, skew bonds and volatility, selling premium, technicals and time frames, oh my, it does not stop. If you name a topic, seriously, you're in chat right now. Name a topic. I can probably show you a coaching session done on it. All right. And if that's not enough, like if you're more into technical analysis, I get it. Let's look at technical analysis. Go to October. By the way, I have no idea off the top of my head, but if you go to October, analyzing price momentum, trading automation out here, selling puts to acquire long stock. That's actually a mini class. Back to the archives over here. I cruise down, you could even look at just the Jeff Bierman archive. If you're into technical analysis and you know that you like technicals, do you want to know about fundamentals? Do you want to know about candlesticks and channeling and volatility and oscillators? Okay. Does Jeff talk about oscillators? Oh, yes, Jeff talks about zero line oscillators. That was today. All right. Market cycle indicators, complex reversal indicators. You name a topic and it's in there. And that's why we do this. Okay. If people look at the price and they go, oh, $9.97, what's the catch? Here's the catch. The brokerage firms, okay, want your business. And much of your tuition into TheoTrade is being provided by the brokerage firms. We do not tell you what brokerage firm to trade with. Okay. All we tell you is that we do have agreements in place. We have marketing relationships with a number of major brokerage firms that help offset your cost of going to TheoTrade. I ran education, okay, for TD Ameritrade for many years, and there's 7 million clients. TD Ameritrade clearly is one of the firms that we have a marketing relationship with. As such, okay, they help offset many of our costs, and that's why we are capable of doing everything for an entire year for $997. Okay, they want our clientele. They want your business because their clients, right? The average uneducated client might not do that well in the marketplace, right? The clients that go through our program, these people know what they're doing, and that's the most important thing. By the way, Theo, the Total Theo, it includes the butterfly class, right? Because somebody asked that, so it's in there too. So, yeah, by the way, there's a new brokerage firm that's going to be on the street over there. Yeah, absolutely. We're talking to them right now. So theotrade.com/fly. I'm going to answer a few of the questions that are in there. So John, that was a good one. We're in contact with everybody. And listen, I worked at thinkorswim for many years, still in touch with everybody, okay, over there. By the way, feel free to also, here's our email and support number, okay? So if you need some additional support over there, there's the email address, support@theotrade.com, our phone number over there. Okay, most of the stuff you can also come in here and say chat now, right? So there's live chat available in here as well. See if I can answer. By the way, account size over there. So in terms of account size, as I said, you'd have $2,000 in an account. Butterflies are dirt cheap trades. I cannot stress to you enough, of all the trades that I do, and I do a lot of different trades, the butterfly to me is, without unequivocation, the easiest entry and access point for the vast majority of you to get to know this business. The butterfly itself is not, historically speaking, again, a very high probability trade. But in conjunction with the expected moves, okay, we are altering the probabilities in the butterfly, and that's the most important thing over there. So, by the way, yeah, so you can come in here. Again, you can go check out the class. Again, the class itself is $197. It includes options 101, 201, 301. By the way, for those of you, again, just because it says options 301, you're like, I'm beyond that. Trust me, you got to go to at least the 301 class. You will love the class. I spent a lot of time talking about volatility and expected move, and that's always been my personal mantra. I'm all about volatility. I've always been about expected move over there. So that class, that one kind of does it for me. I really like this particular class. There's stuff that I really, really get into. The butterfly, that's all well and good, but around the expected move, I'm loving it. With that, okay, I, again, urge you guys, check out the classes. If you have questions, feel free, reach out over here. Again, most places, one class is $1,000. So you will not be disappointed to what you get for $997 on total Theo. And sure, I stress that to everybody because, the value in here is not just all the classes, but email us for support. We're here to help. That's pretty much what we do here at TheoTrade. So thanks everybody for, and by the way, Susan, the answer is absolutely yes. Thank you everybody for joining us tonight. And hopefully I'll see you not only in the class, the Butterfly's Guide to Weekly Returns, but you can join us right in the chat room tomorrow if you are in Total Theo. Thanks everybody. Have a great evening. Bye-bye.